In this video, you will learn everything you need about the reward to risk ratio. What is the perfect reward to risk ratio? What happens when the market moves? What is the dynamic reward to risk ratio? How do you scale in and out of the positions? What is the perfect time to exit a trade? And many more things when it comes to dealing with trade management decisions. Let me take you through some trade examples and see what happens to the reward to risk ratio. So assuming we take a breakout trade here, it doesn't really matter the entry. What really matters is what happens afterwards. So assuming we set our target this way, we take a breakout trade. Here's a previous supply and demand area. And this would give us a theoretical reward to risk ratio of 5-to-1, which is pretty decent, but let's see what happens actually. The first scenario, what happens when the market moves against us? So you can see from the entry, the price moved against us. And one common thing that many traders get wrong is that the worst time to cut a losing trade is when it approaches your stop loss. This may sound counterintuitive, but let's see what happens to the reward to risk ratio. Now our price is here. Our stop loss is unchanged. It is still here. And our target is also still unchanged. It is here. And what does this mean now for this trade? There is now a 22-to-1 reward to risk ratio. And we started with a 5-to-1. So the reward to risk ratio has actually improved significantly. And what does this mean? It means that if we cut the trade now, it is probably one of the worst moments to cut a losing trade, because if we stay in this trade and we let it ride out, obviously most of the time it's probably going to hit our stop loss, but the 22-to-1 reward to risk ratio means that only 1 out of 22 times the market has to reach the target to make this at least a break-even trading opportunity. So you need to have a very low win rate. And the win rate based on the 22 reward to risk ratio is around 4 to 5%. It's around 4.5%. And you can see you need to be only right, let's say every 5% in such a scenario to make this at least a break-even opportunity. So as the trade progresses against you and moves against you, we don't want to move your stop loss. Obviously, the stop loss stays in the initial place. At the same time, it gets less and less interesting to actually cut a losing trade as it reaches your stop loss, because the odds just improve so much. The next scenario, what can happen is the market moves in your favor. Obviously, this is the ideal scenario. And what happens now? Now the market is trading at this price. Our stop loss, if we haven't moved it, and we come to stop movement in a moment, is still here. And our target is also still unchanged. It is here, so roughly here. And this gives us now a reward to risk ratio of 1.2-to-1. And obviously this is a significant difference from the initial 5-to-1, and it's also hugely different from what we have seen previously at a 22-to-1. So what happens now? As the price moves towards your target, the conditions of your trade become worse and worse, because if you don't move your stop loss, now you have more to lose from where you are currently, and you don't have as much to gain, whereas previously there was a lot to gain and not so much that you could lose. And this is a general question that I always like to ask myself: how much can you gain and how much can you lose where the trade is standing right now? So this will help you make a few better trading decisions, because now you can obviously, and you have to do something. What are you going to do with this? You're just going to sit it out, and you're going to have all of this risk here in your trade that you could give back all of your unrealized profits, and there's not so much more that you can gain. So one natural thing is we're going to move our stop loss. And stop loss movement is not just as simple as, okay, let me just move my stop loss closer to my trade and then it's protected. Because obviously the closer the stop loss is to your entry, it is easier for the price to reach it. And therefore stop loss movement has to be done with a lot of thought, and it has to fit into the chart context. And when it comes to moving a stop loss, you could choose things like a trailing stop with a moving average. You could trail it behind previous swing highs. But the most important thing when it comes to stop loss placement in general is that it needs to be protected. And when it comes to protection for a stop loss, we talk about previous swing highs, natural support and resistance, but also volatility. So however, how much the current market that you're trading is swinging, you could use, for example, the ATR or the Bollinger Bands to get an idea of how much volatility is there. the closer or the further away needs to be your stop loss, because it needs to account for the market volatility. So let's assume we move our stop loss to a closer point. Let's assume our moving average has come down now here to the recent price action, and this is where our current moving average is, whatever time frame moving average we're using. So, and we don't want to put our stop loss right at the moving average, because obviously the market is going to trade around a moving average very often, and we want to make sure that even if the market hits the moving average and makes a little bit of a retracement through it, we want to still be in the trade. So now you can see we have improved our stop loss from 1.2 back to 6.6 to 1. So it has improved a lot. At this moment, there's not so much more that we could lose, but there's a lot of upside still to have. And this stop loss and this trade now makes more sense in the whole chart context, because we're taking into account the trend structure. We know that, okay, if the market has made a significant move to the downside, there's a higher risk that we are going to see a correction wave. And we want to make sure that our stop loss is not going to be hit during a regular correction wave. So this all needs to be put into context. And a more important takeaway, or a very important takeaway as well, is that as the price reaches and gets closer to your target, the reward to risk ratio conditions get worse and worse. And this means that the closer the market will eventually get to your ultimate take profit, the more aggressive you need to be with trade management. Because let's look at what is happening now. We are very close to the target. So our initial target is set down here. The initial stop loss was all the way up here. So now at this point, it would be a 0.3 reward to risk ratio. With our trade stop loss approach from previously, from here, we are now looking at 0.89. So the reward to risk ratio is worsening and worsening as the market moves in your favor. This is one of the more important takeaways in this video. And the closer it gets to your target, there is always going to be limited upside. So obviously now how much more you can gain is reduced, and there's not much more downside potential here. And as the trend unfolds and goes in your favor, this is getting smaller and smaller. So you have a few options now. Obviously, you could just keep trading your stop loss. You could also think about cutting trades earlier, or as well scaling out of a position. So for example, what you could do, as you see when the market is going in your favor, and then maybe you are going to see a double bottom phase, or double bottom pattern, which is generally a sign of weakness, you could then start to get out of the position sooner and more aggressively. Whereas if this happens previously in a downtrend, you see that you have a correction wave, the market is going against you a little bit, then it is not so much of an issue, because the reward to risk ratio is still not as bad, and it is still favoring staying in a trade when you just look at basic odds and statistics. However, when this reaches, or when this happens so close to your target, and there's only so much more to gain, it doesn't really make sense to gamble with this trade and try to really squeeze out those extra few points at the end, because you have already made all of this money here, and it is time to lock in the profits, because there's not so much more here on the downside that would help you extract more profits. And this is something that is very important in your trading. As the trade moves into your favor, be more aggressive with early exits. Obviously, you don't want to cut your trades too short, but you want to make sure that as the trade is really getting close to your target, you are more aggressive. You could even go down to a lower time frame, manage it more closely there. If, for example, news events are coming out, it doesn't really make a lot of sense then to gamble with the news event, because it could be against you, and then you have a spike against you, and there's not much more that you could have made during the news event, but there's probably a lot more that you could give back. So those are all factors that you need to take into consideration when it comes to managing a trade, and what it means when we talk about a dynamic reward to risk ratio. To just finalize the video, let me also give you a few math examples and provide you with a few tips on how you calculate the win rate, the break-even point, and so on. And I will try to keep it as simple as possible, because I know how much people love math. So let's take a look at this example. We have a 3-to-1 reward to risk ratio. Let's assume we are risking $10 per trade. If the market hits our take profit, we make 3 times the risk. So we make $30. If we lose $10. This is a 3-to-1 reward to risk ratio. So what does it mean? What is our break-even point? And it is very straightforward. If we take 4 trades, we only need to win 1. So we make 1 time 30 and we can lose 3 times. And if we lose every single time, we lose 10 US dollars. So we get out with break-even point and we are not losing anything. We are not gaining anything. So in pure math terms, if we trade a 3-to-1 reward to risk ratio, we can lose 3 out of 4 trades. And we only need to be right 1 out of every 4 trades. And when we talk about math, this is 1 divided by 4, and this is 25%. So if you can trade with a 3-to-1 reward to risk ratio and a 25% win rate, you are going to break even. Of course, there's the spreads and commissions to be factored in, but this is the basic math behind it. And then you can do it for all of the other reward to risk ratios as well, because then it's just applying a simple formula. And the simple formula is 1 divided by 1 plus the R. And then you can apply to any of the other reward to risk ratios. So for example, let's take the one for 5-to-1. So we have 1 divided by 1 plus our R, which is 5. So we have 1 divided by 5. What is that? Let's use the calculator so that we are absolutely sure. So it's 1 divided by 6 and you get 0.167. To get the percentage, you can just multiply it by 100 and you have 16%. Or 17% if we round it off. So if you trade with a win rate of around 17% and have a reward to risk ratio on average of 5-to-1 on your winning trades, this is going to give you the break-even point. And this is very interesting to do just some basic calculations when you're looking at a reward to risk ratio. How do the odds look right now? Is it in my favor? Is it going against me? Because, for example, let's take a look at this one, 0.3. So we use this formula, 1 divided by 1 plus the 0.3. And we're going to use our calculator again. So we have 1 divided by 1.3. And now this gives us times 100. It's more simple. You can see we have 77%. So at this point, we need to be right 77% of the time in such a case to at least break even. And obviously, this is a very different story than a 17% around here or even 25% here. And this is what I was referring to when I said as the price moves into your favor and comes close to your target, then the reward to risk ratio decreases, but it also makes this whole trade less and less interesting because you need to be right quite a bit of time to make this at least a break-even endeavor. So this is how you can apply the math. I hope I didn't confuse you totally. This is the general formula. Try it out, use it with different reward to risk ratios, and it will really help you get a better understanding of the risk dynamics.